Thanks everyone for joining. This is the first webinar we're hosting, despite being in existence for 3 years. So we're starting to actively engage with investors on a regular basis, and this is one of those initiatives. I'm Sagar Lele. I'm the co-founder of Rupeeting. Started this 3 years ago. Probably I'll just give a little bit of a brief on what we do and what we're up to these days, and then come to markets and portfolios. So Rupeeting started 3 years ago. We started primarily on small case. We have about 3 equity ETF portfolios, and we started with 6 equity portfolios on small case. Uh, we completed 3 years on them just about in September. So fairly new in the market compared to some of the other managers out there. But been pretty fast growing. We've already reached across all our products an AUM of above 100 crores. AUA or AUM, and that's not only across small case, but a couple of other products that we've also launched. We've got about 1,500 customers now, and SEBI registered across all the businesses that we operate. So very high on compliance. We make sure that we're always in the book or in the good books of the regulator and adhering to all the norms at all times. So coming to what we're doing, we started with small case. Performance has been great for us so far. We've tried to keep our small cases such that they are fundamentally oriented. They're filled with stocks which are limited in number, only 15 to 20 stocks. And we've got a long-term orientation in all of our small cases. So we consciously try to avoid any short-term calls in any of the portfolios that we manage. We're a bunch of people who are all hardcore long-term fundamental analysts, and we stick to what we can do well, and we have been doing well so far. So all of our experiences have been in research analyst or fund management roles at various institutional brokers or AMCs. And that's what we understand the best, and that's what we are bringing to the table when it comes to small case. So if you look at all the strategies that we've got in small case, they would be thematic just in terms of some fundamental element like picking out leaders or picking out large value shifts from one place to another, or picking out some form of disruption in the markets. But you will not see any of our small cases in the category of momentum, or which are sector specific, or which are, say, high beta, or based on a certain factor. One of the things that we've learned across our careers is that fund management is highly variable and volatile in nature, because the markets are such, and you have to keep constantly changing your strategy. So if you stick to momentum as a strategy, for example, it will work when the markets have that element of momentum in them, when there are enough ideas in the markets to work that strategy out. However, we're of the belief that that doesn't last forever. There are times when cyclical stocks will do well. There are times when structural stocks will do well. There are times when growth will do well. There are times when value will do well. So we don't really stick to a particular theme by saying we are growth oriented or we are value oriented or we are, risky all the time. I think the whole element of outperformance on a consistent and sustained basis works only if you are able to change your strategy all the time. And that's the approach we carry across the products we manage, not just small case. Last year, not last year, this year itself, actually, we launched a new product called Voyager, which is a step ahead of small case, I'd say, because most small case investors put in only a small portion of their money into small cases. It's some little bit of an allocation that they choose or spread across several small cases in different products. With Voyager, I think we realized over time that a lot of people and their portfolios have been turned into quite a mess because of the things they've accumulated over time, whether it's recommendations from others, stuff that they've bought by themselves, or a bunch of small cases. People usually end up with portfolios which are very large, which are directionless, and which are a combination of several strategies put together. Which tends to then underperform over longer durations. So the whole point of launching Voyager was that we'll analyze what you've made mistakes in. We'll rectify those mistakes, give you a portfolio that you can streamline, and also manage it over a period of time. So we don't just hand over a portfolio to you depending on your risk profile and what you currently have, but we also actively manage it over a period of time. And unlike small case, where you'd probably put in a little bit of your investments into one product, Voyager is supposed to be your entire core holding or your entire equity holding. So we look at it from the perspective that it should match who you are as a person, what your investment objectives are, and match that with obviously what the current market situation is and what strategy is suited best to outperform the markets. So fairly new product, but we're seeing a lot of traction on Voyager. That's working out really well. So we'll quickly jump to the performance because this is something that we've realized is the number one determinant for anybody coming into our ecosystem. Luckily, the markets have been on our side so far. Extreme outperformance over the last 3 years. The Nifty 500 has post-COVID given a return of more than 50%. So beautiful returns, and we've been able to ride the wave very well. Some pockets of underperformance here and there, but I think overall, if you look at this chart, we are good to go. Anything marked in green is has outperformed the Nifty 500 in that particular period. Anything marked in red has underperformed. So over a longer period, which is 2 to 3 years or more, only one strategy out of all the ones that we've launched is underperforming, and that too not by a very large margin. So we aren't really too worried about the performance here. As I said before, we are very long-term oriented. We encourage people to invest with us only if they're looking at a time horizon of 3 to 5 years. That's how we look at a lot of the companies, a lot of the themes we pick out, a lot of the stocks we analyze. You'll see that in our rebalances as well. We've got minimal churn in the portfolio because our orientation is usually very long term. So we are extremely happy as long as we are outperforming the market significantly over a 3 to 5 year period. And looking at our performance, most of the portfolios have outperformed the markets by at least 15% over the last 3 years. So we're kind of chuffed about how we've done so far. Obviously, Voyager and Pattison don't have that duration benefit yet because they're both products that have been existing for less than 1 year. So we don't have performance highlights for that to a large extent. But this is what we've got. Obviously, value migration is the best performing. Most of our customers, hence, are also in the value migration product. There has been some underperformance in the last 1 month, but again, we're not too worried about that because we've been able to manage cycles pretty well over the last few years. So we're confident that we'll bounce back from there as well. Voyager, still, I'd like to highlight some numbers because it's been about 6 months since we're there. On average, so there are two elements to Voyager. There is one which is the core portfolio, which is the primary holding of anybody. And in addition to that, we provide 2 to 4 recommendations every single month, which act as your satellite portfolio. So the core is supposed to be what you hold for the long term. The satellite is supposed to be something that you play around with, that you invest in, gain some quick money, and then exit. So that's supposed to be not more than 10 to say 30% of your overall portfolio. So in the core portfolio, small time duration, but we are outperforming in 60% of the portfolios we're managing right now, outperforming the respective benchmark. But obviously, again, long-term matters, so we'll wait that out a little bit. On the satellite portfolios, we've got a little bit more action happening because there are every month we're giving 2 to 4 calls. So we've got a decent track record there. On average, in every stock that we've recommended, we've booked about a 10% return. The average holding period is roughly 55 days. So the annualized return, depending on how much we've been existed for, the time duration comes to about 47%, which we're happy about. And a win ratio of 75%. So we're obviously not going to go right in every single call we give. And 75% is a good number to track so far. So that's the bit on Voyager's performance. We'll quickly come to what we think about the markets, and that makes a lot of difference in terms of how we're looking at uh, portfolio positioning and hence how our performance is. So a couple of factors I think I'd like to start with is that we're obviously at an all-time high right now when it comes to the Nifty and the broader indices. But we're also building in a little bit of skepticism at this point in time because of the sharp run up, the sharp rally, and the kind of valuations right now. So we're slightly above the long-term average 1 year forward P that we trade at. However, this what we've seen in our experience is that high valuations tend to last as long as growth is lasting. But whenever growth falters, there is a downward risk to valuations. Now, what we're seeing in the market is that GDP growth obviously has been very strong for India, given the fact that government spending had been high for the last 3 years. There was a very sharp rebound after COVID. And fiscal policy had been extremely supportive of growth. So we've been able to beat most of the global markets despite being in an equally high inflationary situation so far. But now that is changing. Inflation is under control, and central banks, which had raised rates very aggressively over the last 3 years, are now either pausing their rate hikes or reversing the hikes. So we've already seen Europe doing rate cuts. US will most likely undergo a rate cut of 25 or 50 basis points next week. However, India is not, according to us, in a situation where the rate cuts are in the pipeline yet. So inflation is under control, but food inflation is still high. The monsoons have been erratic. And the one difference I want to highlight versus the global economies is that US and Europe actually saw some amount of impact because of the rate hikes. So there was recessionary fears, there were slowdowns seen in their economy, which wasn't the case with India. So the central banks globally have a reason to cut rates and spur the economy wherever they are. But in India's case, growth has started to slow down just a little bit, and that too only last quarter. So we've not really seen a need for RBI to step in and say that, hey, we need to cut rates and support the economy. So two factors. One, food inflation being high, so that is still a risk. And number two, India doesn't really need rate cuts at this point because growth hasn't faltered to that extent. So that's why we think that rate cuts still could be towards December and not before that. But we that's our estimate. But that's also important because that will be the next trigger for the markets. At high valuations, the markets also needs further triggers to keep going up. The last trigger we saw was elections in May, which had a slightly diluted but favorable outcome. Then you had the budget, which again reduced aggression on spending towards infrastructure, but sort of made it up by saying that, hey, we'll do some more welfare spending and take care of fiscal deficit being in check. So that turned out to be positive as well. The next trigger can be in two forms. One, the RBI cuts rates, or number two, corporate or private spending picks up. So far, the government has been carrying most of the load when it comes to spending. But that has to shift towards the private sector, either towards corporates or towards citizens. So increased consumption. So consumption trends are still weak. Private sector capex is still not picking up enough to compensate for government spending, and that's why we are in a situation where we're thinking that maybe you could see some short-term, obviously, spur in the market, but there is a lack of triggers. Overall, while this view becomes a little dodgy for us in the near term, we are extremely positive on India as a long-term story. I think there is absolutely no doubt in saying that India will do well over the next decade. Extremely positive because everything is in place, right? From the demographics to fiscal policy to monetary policy to political stability. Everything is perfectly in place for India to be able to grow extremely well over the next 10 years. So we might see short-term bumps, but we are not worried about where we are in terms of long-term trajectory. And that's one point where we get a lot of questions from people whenever the markets are at an all-time high or when they crash a little bit, in terms of, oh, do we book profits? Do we get out of the markets right now? Our usual answer is that, over a 10-year period, if you see the economy doubling or tripling, corporate earnings growth are going to be much higher than what economic growth is going to be. And that will mean that earnings keep growing and Nifty keeps growing as well. So any sort of dip in the market, we would rather be buyers on an opportunistic basis rather than getting skeptical and selling. So that's our viewpoint, and that will remain for the next few years. So at any point in time, you see your CNBC screens all in red. I think it is time for you to collect your dry powder and invest that money into the markets, because the cost of not participating is going to be extremely high. So I think it's a futile exercise to be able to say that I'm going to get out entirely because the markets look high and then invest at a later point in time. Instead, I think the approach should be that you keep some money aside, and keep investing on the bad days. However, I think as we mentioned that currently things look a little risky. So we've tilted our portfolio positioning to create some safety in the portfolios itself. So a majority of our portfolios were very highly oriented towards mid and small caps earlier. It was about 70% mid and small caps. But we've sort of increased our exposure to large caps recently. We've added a lot of exposure to consumer, healthcare, as well as manufacturing, in order to create some safety net in the portfolios again. This actually is the positioning of all our portfolios combined. So it is all the six small cases, plus our Pattison PMS exposure, plus our Voyager portfolios. So it reflects what we truly think as a group, as an entity, and this is something that is a common strategy element across our products. So you'll see a lot of large caps being added, and a lot of defensive sectors being added as well. So strategy going forward is also going to be towards capital protection. I think we are slowly shifting gears and saying that it is, let's not get very aggressive and chase growth. I think there is a little bit of a few weeks or months that need to be spent in protecting what we've made, in protecting the returns and saving our principal, rather than chasing growth aggressively. So that is the gear shifting we're doing, and I think that strategy will last a few weeks till we again probably shift gears. We'll probably stop here and take a few questions from anybody in the audience who has them. So probably if you can raise your hands on the screen, we'll be able to draw you up. Sorry, Pratik is, yeah.
Yeah, so Sagar, just before taking the questions from audience, if you could just highlight like what is, because a lot of people on calls ask us that, why should we invest in Voyager when we have small cases? So, if you could just tell the fundamental difference between Voyager and small case so that, people get some idea regarding that also.
Yeah. So, see, I think small case is supposed to be, I mean, it's become a tool for getting that extra. It's just a product in your portfolio. So you have a few mutual funds, you have a few direct stocks invested in. And then you buy a small case because you like the manager or you like that as a product and you get some extra returns out of it. So it becomes a small part of your portfolio. We've not seen a lot of people with a majority of their investments in a single small case. Also, we've seen that small cases are, except us and a few others, a lot of small cases are very sector specific or theme based in nature. So you can't really make that your core holding and your entire equity exposure. So Voyager here differs where we're saying that if you if you need us to manage your entire equity exposure, that's where Voyager comes into play. And this becomes important because your portfolio needs to be reflective of who you truly are. So what is your risk profile? Are you a risk taker? Is it high? Is it medium? Is it low? What is your age? What is your goal? What are your investment objectives? Are you investing for the next 3 years, or are you investing for the next 15 years? So these questions become important to determine what your portfolio should look like. I wouldn't mind going very heavy on some small caps and micro caps if I'm looking at a 30-year time horizon, for example. Or if I'm at 60 years of age, I don't have a job any longer, and I need to save the money I've already made. I'd probably go heavy on large caps because it gives me a margin of safety and does not really throw my portfolio around during volatile times. So I think all portfolios are very personal and specific, and they need to be customized. So I think Voyager needs to be looked at as a small case, but which is made specifically for you as a person. And it'll obviously be managed over time. So if there is a change in your goals, if there is a change in your income source, if you get a large amount of inheritance, we're there to sort of recalibrate what your portfolio should look like, and make those changes accordingly. So Voyager, yes. In short, I think your entire direct equity, if it has to be managed, Voyager is the product. Yes, we've got the next. Badri, you can unmute. Yeah.
Hi, Sagar. So I recently joined Value Migration Small Case, and I joined this meeting 15 minutes late. So I am not sure whether you, said something about that particular small case. Um uh,
Yeah, I'll just probably highlight a few things on the small case.
yes, sure.
So performance-wise, that has been the best performing for us so far. So we're extremely happy with how that small case has performed over 1 year, 2 years, 3 years. I think for a long time, it was one of the top 10 best performing small cases overall on the entire small case website. So performance-wise, we're very happy about it. I think we've made a few changes recently. I actually want to show you guys a chart that we prepared, because this question comes to us a lot in terms of what our strategy is and what we're changing in the migration small case. And especially around drawdowns and how we intend to manage those. So this is the value migration small case and how it has moved over time. So since launch, whenever we've rebalanced, we've kind of plotted how the market cap split of value migration was. And if you see how it has moved, we've gone very heavy on large caps now, and reduced the exposure to mid and small caps. So we were very aggressive in terms of our mid and small cap exposure. That's what led to the very high returns that you've seen, the 170 and whatever percentage over the last 2 years. But I think, as I said, we're changing gears, and we're sort of shifting towards large caps. The other thing is also the sector split. So if you look at defensives versus cyclical and others, we've reduced the portion of cyclical stocks significantly in the value migration small case, and we've ramped up on how the defensives are. So again, we're changing gears. One last rebalance. Our last rebalance came in just yesterday. So all of you guys who are invested in the value migration small case will get rebalance notifications on Monday. We changed about 30% of the portfolio is something that we rebalanced. So it's not only these changes that we've made in the rebalance where we've tilted our exposure to suit the markets, but what we've also done is cut out some of our underperforming stocks. So we had exposure to 2 or 3 stocks which were relative underperformers. There was one called Asian Granito and MTAR Technologies. Both of these stocks had given us not great returns over the last whatever period that they were in the portfolio at. So we've taken the opportunity to also cut out that and add some more meaningful and promising names into the portfolio. So that's where we're at. That being said, I think despite the safety, I'd like to highlight that that does not mean that returns will not continue. So even if a large cap is added, our stock selection process is such that we would choose companies that have growth potential and that have triggers. I want to take this opportunity to highlight how we think about stocks when we're selecting them. We have this framework called SEVT. So we basically focus any stock selection, whether it is a large cap, whether it is any industry. I think what we focus on that it should have a long-term narrative and a structural story in place. So it should have some amount of driver over the next 3 to 5 years. There should be some story, some movement in the company which takes it from one place to another and drives a lot of the earnings or valuation for the company. The second is obviously that story should reflect in earnings growth, which is higher than peers, and that should also reflect in valuation re-rating for the company. So if these things are not in place, we do not pick up a stock in our portfolio. And even in the recent additions, we've added Marico in the large cap space. A couple of weeks back, we added ITC. We see triggers for these stocks as well. It's not like these stocks will remain flat. We have added them only from the perspective of making returns. So over longer durations, although you may probably say that, hey, large caps maybe give lesser returns than small caps, that may not necessarily also be true. There are tons of large caps which have, outperformed mid and small caps as well. So yeah, those are the changes in value migration lately.
Thanks, Sagar.
Sorry, Abhishek, you have a question.
Yeah. Hey, hi, Sagar. Thanks, Abhishek, this side. So I have couple of questions regarding value migration portfolio. So my first question regarding the Majgaon Dock Shipbuilder. So over there, first of all, congrats that you find a multi-bagger and it gave very good returns. And then it goes down also around 25%. And I've seen that there is a communication or mail came from team that this stock is still going to go further, like going to go do good in the future. It have great order book and everything. I think good, and a lot of government initiatives is coming on the way. But then after a few days, this stock is removed from the value migration. So I want to know the rational reason behind that. That if one side we are thinking that it's very good, but then we still removed it.
Yeah. So I was expecting some bit on this because our timing absolutely sucked when it comes to the blog and this. See, I'd like to tell you that we're positive on Mazgaon Dock, right? We maintain that. We're still positive on Mazgaon Dock from a long-term perspective. We think the stock will do well. It's in a position where the order book is great. Government initiatives towards defense are perfectly in line with what the company is doing. However, there are a couple of things here. One is there are short-term challenges we foresee, not to an extent where it's already propped up. So what's happening is that they're getting new orders now for a new class of submarines that is expected to come in. They've tied up with Tyson Group for that order. So whenever we've seen that a new class of submarines is added or a new class of frigates is added, the company needs to do a little bit of investment, and then it ramps up on production. So there is a little bit of lag between preparing for the order and then booking revenue after that. During that period, we've seen that margins usually falter for these companies. And once margins start faltering, then usually the markets are not really forgiving. They kind of thrash the stock a little bit, and it goes through a rough period. We've seen that with any form of expanding company. A good example from a completely different sector is also Jubilant FoodWorks. Very aggressive growth, started compromising on margins in the near term. Stock started getting bashed. When that turns, however, where profitability catches up, then again the stock does well. So that's one of the factors. We saw some near-term challenges, and hence there was a change in the value migration portfolio. Number two was that the stock at the end of the day, even if we like the stock from a long-term perspective, we are talking about managing a portfolio which can be a little different compared to individual stock selection. So as I said, we wanted to add large caps. We wanted to reduce the amount of risk in the portfolio. We wanted to turn into a capital protection mode. At the same time, I think we're also at this place where defense, amongst other sectors, are at peak valuations. So from when the markets are at an all-time high, if we are supposed to look at what will make me the next best return over the next 1, 2, 3 years, right? Which sector will give me that? It is definitely not a sector which is at its all-time high. So we are also going very aggressive on consumer right now because it is one of the sectors which has underperformed over the last few years. We're going heavy on banks right now because that is again an underperformer for 2024. So
Yeah.
we think the sector rotation factor also plays a very important role in determining portfolio level returns. So wanted to cut out on some of our exposure in defense for now. We're not ruling the stock out completely. We may add the stock again in a few months. But this at this time, looking at the rest of the portfolio, it is definitely not a fit in the value migration small case.
Oh.
Yeah, that's
Okay, cool. My second question regarding the MTAR. So MTAR was there in the portfolio, and then if the promoters' holdings start decreasing and they were not fulfilling even their promises, what they were committing every quarterly meeting, the targets they were not as fulfilling though from last I think 3 quarters that was happening, and but this stock was still in the portfolio till now.
yeah.
Although I was not confident, so I cut out my position 1 quarter back. But I just hoping that I'd seen that yesterday in the new rebalancing you also cut out. So want to know the reasoning behind that. Why we kept it, because it is not meeting the promises, and also the promoters were continuously selling. So still it was there in the portfolio.
Yeah. So with MTAR, I think, see, it's again one of those companies which we like from a long-term perspective. However, it went through some short-term challenges. A majority, I agree about the promoter selling, but there are a couple of things here. One is promoter selling has become a very common phenomenon in the markets right now. So the amount of seriousness we'd attach to a promoter selling, say, 3 years back versus the amount of importance we attach to it now is materially different. So I think we took it a little lightly that promoters are selling, because the reasoning behind promoters selling was also to do with their personal expenses and carrying out some restructuring in the family. So you're like, if it's personal, then we don't want to. It's not really totally entirely signaling that they don't have confidence in the company. That's one. And second, I think the promoter selling also overlapped with a time where the company was missing on its targets. Usually, when a promoter is selling when everything is good, signals that the stock is at its top. When a promoter is selling when things are rough, it can be more associated. You can give them the benefit of doubt and say that, hey, probably you required the money and hence you're doing it. That's one school of thought. The other thing about MTAR was that there was one customer which was problematic. So their largest customer, called Bloom Energy in the US, has been facing some issues, and the spillover effect was on MTAR Tech. So do we think that fundamentally the company's faltered somewhere? No. Has their positioning strategy or product portfolio gone down? No. Have they are they're still present in very high growth sectors like clean energy and defense and space? They're doing some cutting edge work. So with good companies in high growth sectors, what we've also seen is that during times of this roughness, during these transitory periods, the markets can be a little forgiving, and the stock can bounce back pretty fast. So we gave it the benefit of doubt. We waited a few quarters. I think we waited a little more than we should have. But I think we've lost the patience now and said that let's cut the position out. Closed it at a 25% loss and said, let's move on. That said, we still maintain that I think MTAR is a great company with some great services out there. So we might just look at it in a future date as well. But yeah, I accept that we got a little late in terms of exiting the stock.
Okay, great. My
But
third
again, sorry,
question.
just to add context, what also happens is that in the portfolio, when 13 stocks are doing really well and two aren't, you give yourself that leeway as well, that it's okay. You can afford to wait a little longer. You know what I mean?
Yeah, yeah.
But the portfolio performance is bad and you're waiting it out, then it doesn't make sense. Even as a portfolio manager, you lose patience because you have zero tolerance at that time, zero tolerance for giving anybody that benefit of doubt or showing that patience. But I think with value migration, when we are sitting on 180% return, we're like, it's okay. If one stock is underperforming, we can wait it out and see how it goes. We can afford that kind of patience.
Yeah, that's true. I just I did not like the fundamentals of MTAR from last 2 quarters, so that's why I got little impatient about that. Okay. My third question is regarding Asian Granito. So I studied the sector, and over there I found that it is not very growth sector. First of all, tile market is not you cannot make much profit out of it. Third, that there are a lot of unorganized sector around that, and again that same thoughts. Asian Granito, it was again going with the fundamental challenges as well. It might be turn around the story, but after I wanted to understand what did you see extra which I can't see into that, and um it was it was in the portfolio, because from my what I see, it is not in good sector and also not in uh, a growth trajectory where it can grow.
Yeah. No, Granito, the fundamental or the prime reason behind investing was that they were shifting from a B2B to B2C market, right? They were planning on expanding their consumer product portfolio, taking out products in sanitary ware and ceramics and stuff like that, where they're directly selling to customers or through dealers or whatever, but creating a consumer presence. Now, these stories usually play out very well. It depends a lot on execution. And we've seen many areas where companies shifting from business to consumer have done extremely well. And that's because suddenly you get the pricing power. Suddenly, you've doubled or tripled your addressable market in a very short span. The brand gives you value-added products. It gives you a sudden revenue boost. It gives you better margins, and you get better valuations as well because you're a consumer-facing company versus a business-facing company. So that is the theme we wanted to play in Asian Granito. We've seen that play in a lot of like cable companies or a lot of sectors. So I think that theme is something that we wanted to play, but it didn't work out at the end of it, and we exited the stock. So I remember the time we added Granito, actually the stock shot up some 30-40% within a week. And we were like scared that we'll have to book losses immediately, profits immediately. But then yeah, the story just didn't play out. So we waited it out, but I think we cut it at the right time as well. We cut it when the stock was still 25% up for us in the overall portfolio. Yeah, that's the brief on it.
Okay. Yeah. My last question regarding the PSU banks. So, what do you think? How they are? What is their growth trajectory in the future? We have one of the stock BOM. I don't know if you have removed it now.
Removed
Uh,
it.
okay, but yeah, what is your point of view on that?
So the point of view on PSUs in general was that we've seen a lot of run up, and that applies for public sector banks as well. At the same time, we've seen that private sector banks have underperformed massively over the last year. Our immediate call is that while Nifty will, at least in the short term over the next week or two, see a little bit of more positivity, Bank Nifty will also probably reach its all-time high. And that will be contributed to by the private sector banks. So we're seeing a shift now that the outperformance that you've seen in public sector banks over the last 3 years, you might just see private sector banks catching up over the future. So we are also very actively shifting our exposure from public sector banks to private sector banks. And in our recent rebalance and value migration, again, I think we got rid of Bank of Maharashtra and added Axis Bank. So that's aligned with the viewpoint that private sector is the way to go, at least in banking.
Okay. Yeah. Thanks a lot for your answers. Quite satisfy my
you.
thoughts. So thank you.
Yes. We'll take the next one from Sayan.
Hello, sir.
Hi.
I am recently subscribed value migration small case. So I want to know the value migration is following only value factor or maybe market changing value to momentum to quality. Then according to market condition, value migration shifting.
Sorry, we've lost you there. Is it only me or
Hello.
everybody else also?
I
Hello.
know there's some issue with the audio.
Okay.
Yeah.
Yeah, hi.
Could you repeat the question, please?
I am recently subscribed value migration small case. So I want to know that value migration is only following value factor or changing market condition, value to momentum, momentum to quality. It's also changing his strategy.
Yeah, so value migration, I think, isn't primarily the value factor as such. What we look at in the value migration small case is that value in any form, not from the valuation perspective, value shifting from one place to another. So, like we spoke about banks right now, there is a valuation difference between public and private sector banks which was playing out so far. So that can be a form of value. Another form of value can be the shift to indigenization and domestic production for defense. Another shift can be from unorganized retail to organized retail. It can be from brick and mortar to retail, online. So we're looking at any form of value shifting from one place to another and that making money. So it's not necessarily it will not necessarily invest in value stocks. So we don't really hunt for stocks which are cheap in valuation at this point in time, or that have a mismatch between the price that they're traded at and the value or the intrinsic value of the company. I think that is an approach we carry out in any small case or any investment approach. But this small case specifically would be a combination, to answer your question more specifically, a combination of quality as well as value, as well as momentum, as well as growth, depending on the market situation. I think the important factor to look at is any economic shift triggered by changes in how the market is operating.
Thank you so much, sir.
There was one more question in the chat on the structure of Rupeeting and Pattison now. So what's happening here is that everything remains the same right now. We've got a team of 4 fund managers. We've got a team of about 4 or 5 analysts. We are very strong in our research and investment approach. If at all, with the merger or the joint venture with Pattison, our strengths have probably just improved because Pattison also comes with a lot of investing experience. They come with a very deep-rooted connect in the South Indian market, especially. So they've actually got a depository DP as well. They're into stockbroking and DP. In their DP, they've got a few thousand crores of assets. And a lot of these assets are actually promoter holdings in their own companies. So TVS Group, Sundaram Group, MM Forgings, Apollo Hospitals, a lot of these very reputed companies from the south, their depositories and dematted shares are actually, promoter holdings are actually held with Pattison. So very good connect with the management, very good corporate connect in the south, very good customer relationships. In fact, a lot of these promoters are also customers of Pattison. So if at all, I think we've improved on our capabilities by venturing with Pattison. In terms of teams managing the funds, they're common across small case, Voyager and Pattison PMS. I think we are sticking to what we're good at, and we are managing portfolios all across. Sales and structure, organization structure, etc., those things are being changed, but nothing is changing on the fund management side at all. So In fact, it's getting better. I think we've recently, because of Pattison, also placed a investment committee in place. So any stock that gets selected in the entire universe, whether it is small case Voyager or with the PMS, it goes through a rigorous process of not just analysis from the research analyst, but also very stringent selection at a fund manager level. And then on a monthly meeting, it is discussed with the entire team of investment management, back office, sales. Everybody's on this one singular call. We discuss these ideas, and we invite a lot of criticism as well. One of the things that we implemented that I want to talk a little about is that every month the analysts are also supposed to question the fund manager and give a sell idea from the existing recommendations. And that is a compulsory activity we've put on. So that every month there is one analyst at least putting out a detailed thesis and presentation on why this particular stock should not be there in the portfolio. So that, the fund manager also goes back, thinks about what is happening, maybe changes that. So we're all aligned towards a singular objective of outperforming, and I think we're just getting stronger there. Request to talk about socially responsible investing small case. I think there the performance is, again, I think we're extremely happy about how that portfolio has performed. There have been some recent changes in that. Probably Chaitanya, you want to highlight some of the changes there?
Yeah, I think in the socially responsible, we are going now sectoral changes. So I think there we are possibly increasing the information technology sector heavyweight, because in the last few years that we have seen that IT has relatively underperformed, and going forward in the anticipated low interest rate environment. So and that also in that itself, we particularly like the mid cap IT sector, which we think are better positioned to perform well in the low rate cut environment, because the large cap IT companies are pretty much equally invested in across the market, where mid cap companies specifically focused on US and Europe market will be the one benefiting most going forward. So that is our focus, and similarly some sector which has performed well for us in the past, so we are doing profit booking as well, such as the banking and all those things. So that is the biggest change that currently going through, and going forward we'll keep monitoring that how that will be changing also.
So other than banking, the other call that the small case also took was of investing in financial services. Not necessarily financial services, but intermediaries, more like CAMS and CDSL is what we picked up there. So both, so we're also, one of the conscious things we're doing across small cases is also backing a lot of the leaders in each sector. So we're liking the entire, we're seeing a shift where what will do better in the future are market leaders or duopolies or monopolies, or the leading company in whichever sector we're invested in. So we're also actively taking a position of going heavy on these leadership companies across small cases. So with both CAMS and CDSL, both of those are stocks which have a duopoly in their market. So we're very comfortably placed when it comes to the positioning there. Sorry, Abhishek, you've got something else.
Yeah, so I have another question regarding Tata Power. So if I compare Tata Power with the Adani Power and over there, so the first Tata Power's valuation is quite high compared to Adani Power, almost P is double. And second is their growth guideline is I think 10 or 12% of Tata Power, if I'm not wrong. But whereas Adani is they are going to do their self double in coming 2 years or 3 years down the line. So my question is first of all, keeping that Tata Power in the portfolio, why? Second is if valuation front side, if you calculate their forward P, still it's come around the current valuation which is currently going on.
Yeah. No, so I think there are 2-3 layers to that. I think the number one layer I'd like to highlight is that we usually avoid the Adani Group. And that is a call we're taking at a group level, irrespective of whether it is Rupeeting, Pattison, whichever product. We are a little too skeptical of, and I think that has to do a lot with our backgrounds as well. I mean, I worked and managed in a fund which was Japanese, and they are extremely heavy on corporate governance and very careful on these things. So anything sketchy about any company, we usually stay away. And we're not saying, or we're not concluding that Adani is sketchy. There's no one to say that. We're just saying that if it doesn't give us the comfort, and if the market is gonna treat it in a volatile manner, or if the stock is gonna see very large deviations because of questions raised on corporate governance, we would avoid taking a position on that, because we just don't want either us or our investors losing sleep over holding a stock which is extremely volatile. So in general, I think other than Ambuja Cement, which is a recent addition to the Adani clan, we've in general avoided the Adani group. And this is not only true for Adani, we've avoided a lot of these companies which either have historically had corporate governance issues, or there are questions raised on them. Whether it is, solar industries, it can be that Suzlon, it can be any of those. We've consciously
Right.
stayed away from them. We're like, hey, let's go slow. So that's one layer. The second layer is that with Tata Power, we also get a very diversified theme. So you're not only playing the generation side of power, but you're also playing distribution. So Tata Power is a very diversified play when it comes to the power sector, and we are currently preferring diversified plays in the power sector, because we see that whenever demand sort of turns after the peak season, discoms usually face a little bit of pressure, and gencos do really well. So to avoid pressure from one side, we sort of stuck to a company which has both distribution as well as generation. On the generation side, we like Tata Power, especially because of the kind of aggressiveness they have on the renewable side. So after NTPC, if there is a power player that we want to back when it comes to the entire renewable portfolio, then we are on the Tata Power side. And in terms of distribution, we see room for turnaround in a lot of the underperforming sectors that Tata Power is currently present in. So we see a potential for a turnaround there, and hence earnings growth as well as re-rating, as well as I think structurally we're also in a place where distribution has to see a lot of changes when it comes to implementation of smart meters, making the grid more efficient, stemming the transmission losses, stemming AT&C losses. So all of these things we also think from a structural standpoint will improve the entire distribution scene. And hence we think putting into a combination of these factors, we think the valuations seem reasonable for somebody like a Tata Power.
But Sagar, so if I see Tata Power or whether Tata Chemical, both are having their guidance of forward future earnings are quite low compared to, or like just average. So don't see any much bigger growth coming on to when I read their quarterly reports or a management guideline. So
Yeah.
that makes a little bit skeptical.
No, I think it's also so the guidance for power companies also usually doesn't factor any pricing or demand surge and stuff like that, right? Like at the beginning of 2024, or even in 2023, if you kind of look at how much the government tried for generation companies to keep up to the mark in terms of coal supply, in terms of arranging for railway routes to be emptied just so that coal reaches generation companies, changing a lot of rules in terms of import of coal just so that peak power demand is met. I think those are encouraging factors when it comes to power companies. So despite the low guidance or whatever, I think we are still in a place where every single year you're seeing the peak demand, especially in the summer, contributed by both consumers as well as industrial, being surpassed by the previous year by a very large margin. And earlier, the issue was not demand so much. The earlier issue was also supply. But it's very encouraging to see that the government is also sort of aligning that supply on. So from that perspective, I think despite the guidance, we find it very comfortable to sit on Tata Power from the perspective of capacity addition and a lot of their power projects again. So guidance may be like low for the next 1 year, but again, the kind of addition they are doing in terms of both hydro as well as solar, we're confident from a 3 to 5 year perspective that Tata Power will quite emerge to be one of the leading players there.
Yeah, makes sense.
Tata Chemicals, yeah, because Tata Chemicals, again, I think they're present in and that's why we also got rid of Tata Chemicals to a certain extent, because they're already one of the largest players in both soda ash as well as soda bicarbonate. And being one of the largest players globally, that market itself will continue to grow at 4 to 6%. Now, in that, the smaller players you can still argue that will grow at, double-digit growth. But Tata Chemicals, we didn't quite see a potential for double-digit growth, at least in their primary business of basic chemicals. We were, I think, more invested in them because we saw a lot of potential in their value-added products. So they're trying to diversify away from the soda ash business, and they're trying to add nutraceuticals, silicon products, industrial chemicals. Rallis is doing really well. They have a stake in Rallis, which is fertilizers and pesticides. So we saw a lot of potential in the rest of the business. And for us, Tata Chemicals was a story where you have a cash cow in the base chemicals business. And that is being pumped, that extra money is being pumped into new emerging businesses, which are very high growth businesses. So we were sort of trying to play the composition shift of base chemicals to others. If it was 70 to 30, when it moves the other way around, there'll be a lot of change in terms of the growth dynamics as well as valuations for Tata Chemicals. But again, I think the wait has been too long for Tata Chemicals for us, and we saw that the opportunity cost is high, and hence we moved out.
Okay. And do you see any shift in chemical sector coming or any new developments coming?
The chemical sector has been sort of disappointing. I mean, because China's played a very large factor in terms of how pricing has been subdued. So we still see a little bit of pain, because what happened in the chemical sector was volumes went down because of the macro situation globally. Pricing was subdued because of China. And third thing, what happened is everybody went very aggressive on capex. So they made a lot of investments, but uske samne we weren't getting enough revenue and margins. So it was a very bad mix for most of the chemical companies. We see some pockets which we like. So we don't like the entire sector. We are being very selective when it comes to our positioning in the chemical sector. For example, we've only probably held something like a AMI Organics, which we are positive on. And other than that, I don't know, Pratik or Chaitanya, if you know, what other chemical stocks do we find? Or no, we don't even have that. I think that's the only stock we have right now in chemicals. Do we have anything else?
We have a very small exposure to Camlin Fine Science because of the it has been beaten down so much. So we don't see more downside to that. But apart from that, yeah, we have last was the Tata Chemical, as we remember, which we got rid of yesterday.
Yeah.
So we are very underweight on chemicals right now.
Yeah. So I think there is still some pain, right? Because again, chemical prices are still coming down. The capex situation hasn't gotten better. There is oversupply in the market. And you're in a place where since the last 3 or 4 quarters, every single chemical company on their con call, they keep talking about, next quarter it will be improved, next quarter will stabilize, but that next quarter hasn't really come. So we want to see some early signs of validation in numbers and not in management commentary. Once we see those signs in the numbers, I think we'll start taking positions in chemicals. But otherwise, I think we're at this point, at least we're off chemicals.
Okay, thank you.
Yes, Batri has a question.
Yeah, Sagar. So, is value migration a model portfolio or it's a personalized portfolio? Because you mentioned Marico, but I don't see it in my, in my portfolio. I mean, in my
No, so we made that change just yesterday. It is a model
Mm-hmm.
portfolio. We made that change yesterday. So what typically happens is that whenever we push a rebalance on small case, it goes to investors on the market opening, the next market opening. So because today and tomorrow the markets are off, you'll get the rebalance update on Monday morning at 9:15. That's when you'll be able to churn your portfolio and rebalance it. So it will reflect in your portfolio Monday onwards once you execute it.
Thank you.
There was a question on not having two rebalances in the same month. Not one off. I think we've stayed away from defining our um, rebalance frequency. I don't think we want to get into a stage where a lot of managers out there say that we'll rebalance our portfolio on a monthly basis, quarterly basis. We don't like to do that because I think the markets are very volatile and you have to be sometimes proactive, sometimes reactive to the markets. And if you say quarterly, the markets are not going to wait for you at the quarter's end to, act according to you. So we like to be more on need basis whenever we feel that, hey, now there is time for change. Either we've gone wrong or we think that the market dynamic is shifting or whatever. That is when we make changes. So it is purely, I think, nothing to read into that we had to in a single month. The other thing I think I want to highlight is that there are times when some drastic changes happen, right? Like in the strategy right now, you saw that we are heavily going into large caps and we are adding defensives. So this is, I think, also aligned to that. So we hadn't changed, I think, made any changes in value migration since May 2024. This is one of those times where we said that we need to adjust ourselves to the next few months. And hence 33% of the portfolio changed. But yeah, I think it's just us being a little prepared.
So Sagar, just one request or one consideration. Like in past, what I've seen, there is very less communications coming from Rupeeting regarding portfolio or shifting. So it gives a sense of that no interaction or like feeling that you left uh, left that portfolio not looking much. So just if you can be more interactive as a portfolio manager in terms of whether sending communications or whatever monthly newsletters coming, if they can be uh, more bigger than just a few liners. So which gives us more confidence that why the stocks are there in the portfolio, and what are future plans or thoughts on those on the particular portfolio.
Yeah, no, we realized that because I think a lot of the perception is that if there is no change in the portfolio, then we're not doing anything. But that is actually not true.
Yeah, it came to my mind just someone asked for rebalancing.
Yeah, no, we get a lot of questions in terms of why aren't you rebalancing? And I'm like, not rebalancing is also a decision we're making after a lot of thought and after a lot of research. So sometimes not acting is also a decision. But yeah, I get it. Like people are also very accustomed to a lot of churn, whether it is mutual funds or other small cases. And we are quite against very high churn. Because we are people who sort of take more positional calls. We look at the next few months, place ourselves beforehand, and then ride the wave. And then after riding the wave completely, despite all those near-term pressures, we'll ride the wave completely. And then when we feel the times or tides are changing again, then we'll again change the portfolio. But yeah, I agree. We need to even if we're not changing something, we need to sort of keep you. And that's why I think we've taken a lot of initiatives recently, forming that WhatsApp community, doing the webinar. And yeah, we have a few more initiatives in the pipeline. So hopefully you don't come back to us saying next time that we're too chatty and that we need to cut down on spamming you. So
Great, thanks.
Hi, Sagar, you mentioned about WhatsApp group, right? So how do we get into it? I mean, how do we,
Yes, one sec. Can somebody just put it in the chat here, the link for the WhatsApp group? What we've done is we've started attaching the link in every newsletter also, which we send out on a weekly basis. But we'll also just put in the link. Somebody here will put in the link in the chat itself. So you'll have access to it. Thanks. So on the rebalancing bit, I had actually one more very interesting point where we kind of analyzed how our gross and net returns are. And we figured that over the last 3 years, the value migration small case has given 190% return. And the net return is 178%. So we've typically lost about 18% in transaction charges and costs and stuff like that. And there is a similar small case, and we've rebalanced 13 times over the last 3 years. Now there is a similar small case which has given 190% return, but the net return is 150%. So they've technically lost about 40% in taxes and churn and rebalance costs and stuff like that. So, I mean, we get this common question from people about why we don't rebalance. I think we also aim to, our objective usually is to look at returns from an investor's perspective, and that means taking into account all the costs that are associated with it. So if we do churn at a very high level and lose out, say, 40% of returns, like the other manager in just 3 years, over a 10-year period, you're losing out on a lot. So I think we're just a little more cognizant of that. The portfolio, so ST, okay, that is a little difficult. We'll have to work out how much STCG, LTCG split is. Chaitanya, any idea?
I think we have to go stock by stock only.
Sorry, yeah.
Yeah, we have to go stock by stock. I mean, when did we bought that stock first in the portfolio? I think we have to look it that way. And then whether it has been sold under 1 year or more than that, I think that we can definitely include going forward.
Yeah. No, so I think the other thing to also probably the way to look at it could be that we are churning roughly 30% of our portfolio, 25 to 30% of our portfolio on a annual basis.
Yeah.
So from that angle, if you look at it, about 25, yeah, so about 50% will be STCG, 50% will be LTCG. Not 50, little 30% will be LTCG maybe.
Yeah.
On average. Satellite, that's a mean comment. Correlation between satellite stocks and Sunita Williams. Yes, I think we are stuck on our satellite recommendations right now. We've had a good run with our satellite recommendations earlier. But I think the recent market condition is a little tricky. Yeah, we'll get there.
So will Sunita Williams.
Yeah, other than the last two, I think we've done well on the satellite recommendations. But there is something coming in the next week. So hopefully our Boeing spaceship will work better.
So Sagar, one question on the amount of allocation in the value migration. So what is the guideline from you as a manager that one individual can maximum put the amount into that portfolio, in based of all the scenarios you can consider, whether it is total capital or maybe returns or maybe risk exposure, etc.
Yeah. So you know what we do? I think that's a great question. And for value migration, I mean, you've seen the shift from it being 70% mid and small cap to now it being 30% mid and small cap. So we are very reactive and cognizant to how the market conditions or the underlying conditions are. So I think you can go a little heavy on the value migration small case if you have to, because unlike, we're not taking an approach where we're saying that this is mid cap, this is small cap, or this is a particular theme or sector. I think you have to be very careful on portfolios which have a particular style. or which have a particular subsect of the market, because then you're curbing on diversification. And for us, at least in the value migration small case, we are of the approach that we're not sticking to those guardrails. We're saying that if markets are changing, we will change our exposure along with that and ensure that irrespective of who the portfolio is invested by, we are doing justice to that portfolio. So I think we'd have no hesitation in saying that you can invest a large amount of your chunk in value migration as well, because the composition keeps, look at it as a flexi cap fund. The fund manager will keep changing the composition, and that's where I think the small case classification becomes a little faulty, right? Because earlier the value migration small case, when it was very heavy on mid and small caps, it was classified as a mid and small cap, as a small cap small case. Now that the classification has changed, it is now showing as a multi cap small case. But I think if it were in our hands, we would set it at a flexi cap right from the beginning. Yeah, I think a large chunk also invested in value migration could be okay, because yeah, we're pretty agile that way.
Yeah. And if I compare the performance of value migration with the let's say flexi cap fund or multi cap fund, so do we have any comparison over years that how it is performed compared to mutual funds?
With mutual funds, no, actually, because mutual funds, the problem is when we do that analysis, we've tried doing that. We've taken a list of mutual funds and tried to sort of look at the mean or the median return. But what we've realized is that the number of funds is so high that eventually you end up plus minus 2%. So
Not able to hear you, Sagar. Is it only for me?
No, I think Sagar is lagging because of the internet
Yeah.
connection.
Is it better now?
Yes,
Yes.
slightly better.
Yeah.
Yeah, so I was saying that we found that exercise inconclusive because the number of funds is very large. So the averages usually come to what the index is. So even when we've tried doing that exercise of comparing us to the average mutual fund return in FlexiCap, for example, we've not reached a very conclusive stage. But overall, I think if you if you place the value migration small case, stack it up against mutual funds, FlexiCap mutual funds, we'd be in the top 10 throughout the last 3 years.
Okay.
Just that, again, for mutual funds, the tax treatment is different, right? But I think the returns here are like 190%. So even that tax, even if it takes out 40-50% of your portfolio, it doesn't matter because the base is so high.
Yeah, over here you always have to pay 20%.
Yeah. Have we missed on anything? We had a few questions from this thing also. Registration link on Airtable. Maybe if somebody could check that also, if there's something we missed. Hi, sorry, Ashwinder. Yeah, unmute yourself.
Hi, hi, Rupeeting team. Actually, I was in a class, wanted to join early. So my question is, would I be able to see this meeting, or can I get the link on YouTube, or can I get from somewhere if I want to revive?
Yeah. So we've been recording this. So we plan to put it up on YouTube once we're done. So you'll have access to it.
Sure.
But if there's something,
Thanks.
we're happy to repeat it as well. So please feel free to ask.
No, I mean, I don't have any doubt as such. So first of all, I mean, very happy with the performance. Great work, guys. Hopefully, it should continue for all of us, seeing these kind of returns. So basically, no, I don't have any such question, but I would be very happy to listen to all the part of the video. So after that, if the link can be shared, would be thankful.
We'll do that. We'll do that. Yes.
Sure,
Yeah, we
sure,
also
thank you.
hope the performance continues. The effort is there. Now the market has to be supportive.
Yes, sure, sure, sure. Thank you.
Hey, Sagar, is the email only medium through which you announce quarterly meetings like this, or is there any other?
So this is actually our first webinar. So what we did was we consciously stuck to sending out communication on email, because what happens is we wanted to see what the kind of response is on email. I think next time we'll do it on WhatsApp. Because what's turned out is that obviously with 1,500 customers and a database of more than 2,000, we've sent it across, but open rates are very poor on email. So we've seen an open rate of roughly 30% on emails, and click rate of only about 3%. That is industry standard. So I think the next time we'll shift our communication to WhatsApp rather than using email for this.
Yeah, that would be a good idea. Thank you.
Yes, Mayank.
Sagar, thanks for sharing so much insights. So basically, I am a subscriber of value migration small case since last 1 year. I hold currently about 7 lakhs in this portfolio, and I am planning to put like 5 to 6 lakhs more. So should I add this in the same small case, or I was thinking of adding it into the rocket ship. Alongside that, I also have that windmill capital value and momentum that's not doing pretty well as per my expectations. I mean, it's not giving some good returns, but so maybe till the date I have subscription, I'm not sure what to do. So need some of your advice on it.
Yeah. So usually what happens is when people end up with multiple small cases, we've seen that the portfolio loses direction, because you end up with like 40, 50, 60 stocks, and it becomes pointless, right? Because then you rather buy like an index ETF and sit on that, because one is doing well, one is not doing well, they cancel each other out, and it just becomes a very messy portfolio. And after seeing that happen with a lot of our customers' portfolios for the last 2 years, that's when we launched Voyager, because we were like, so many people are ending up with so many different products and such a mess in their overall portfolio, that they need help in sort of, reconciling everything, truncating it, and making it sharper. I mean, I wouldn't recommend too many small cases to be added. So one or two are okay, but usually I think we are of the opinion that avoid having too many small cases because it leaves your portfolio directionless. And maybe right now, at least for the last 2 years, you've been in a state where everything in the market is doing well, right? It's as good as random choice. Anybody picks up a stock, it has done well. So it's not required great skill to outperform in the last 2 years. To outperform significantly, yes, it's required skill, but not to outperform. So we think over longer durations, from a sustainability standpoint, anybody is better off sticking by one or two small cases and a little bit of direct equity, um, rather than going all over the place. So for your additional money, I think I would have only two comments to make. I'm very tempted to obviously say, go to hell with Bill, invest with us. I won't say that though. In your interest for me to say that. But yeah, so I think the only things I would say are that don't invest the entire sum at one go. You'll always get opportunities because the markets won't keep going one directionally up, right? There will be some bad times. So you can always keep that dry powder aside and utilize it to invest whenever there is a fall. And ideally, don't take more than two small cases.
Makes sense. Thank you.
Yeah. Thanks.
Sure. So I'm planning to send out my portfolio for review on the website as I saw a few days back.
Yeah,
So
yeah.
hopefully I'll get detailed insights there.
Yeah, sure. I think, yeah, we'll be able to get a better sense of what you already have, and then be able to better answer these questions. Because everybody's portfolio is like unique, right? And everybody's situation is also unique. So I think we have to take it case by case.
Yeah, I understand that.
Yeah.
Sure. Yeah. Sure. Thank you. Thank you very much for my question, for the answer.
So there's one more on you did not receive the notification regarding the rebalance which happened in early September. So what happens is on rebalance communications, there are 2, 3 things that happen. One is if you have the small case app, you will get a notification from small case on the app itself. The second layer of communication is,
Hello.
yeah. Hello.
Yeah. Good morning.
No, I'll mute. Sorry. Yeah. So the second layer of communication is that small case will send you an email and a WhatsApp whenever there is a rebalance. And they will send you reminders of that rebalance as well for the next week or two. And the third one, which we try to do as a manager, is that we try to send out a WhatsApp detailing out why we've changed what we've changed. So we've seen that a lot of times people aren't really satisfied with just a rebalance notification going without reasoning. So that's where we're trying to differentiate and say that fine, you're changing your portfolio, but here is why we're recommending what we're recommending. So these are the 3 things that typically happen. If you could, usually the WhatsApp communication, what happens is that there is a very high failure rate in terms of deliveries. And that is, I think, a universal WhatsApp problem. Only about 60 to 70% of the messages we send get delivered. Um, so there's a very high failure rate. So what we'll also start doing to additionally make sure that nobody misses out on this is that I will send emails as well on the rebalance updates. Yeah. So yeah, I think we'll try to send email plus WhatsApp when it comes to our communication for rebalances. Small case anyway, you've got the notification as well as email and WhatsApp. Could you help us with your email address? I think we'll just check in the system if there is nothing wrong in it. We'll be able to better track down why you haven't received the emails. We'll note this down. Thank you. Airtable, anybody checked or what? We missed out on anything? Nothing. Sort. Cool. Anything else we can help you with?
Sagar, how do we
Yes.
get more details on Voyager?
More details on Voyager. Is it possible to attach files in the chat here? Maybe we can just attach our presentation.
Yes.
Mm. Or we'll do one thing. If you can just help us with your email address, we'll send you the deck for Voyager on it.
Yes, sure. Sagar, I have sent. I have not sent it to all. So if you
Yeah.
just want
So
to,
I've got it. I'll take care of it.
thank you.
Okay, one more question on how can I maximize my returns via investing in value migration by changing my investing value SIP or putting more money while rebalancing? Um, this is it's a tough question because this assumes that we know when the market will do what it will do. I think the best approach to go about it is by doing some SIP. And the second best would be to just keep some money aside. And my most common answer to anybody asking me when to invest is that whenever you see CNBC in red, put some money in. When you see newspapers and TV panicking over the markets is when you put a little bit of your money in. I think that's what we stick by, because that's how you'll get a lot of the averaging done in your portfolio. By investing more money while rebalancing may not be a good idea, because rebalances can happen in different situations, right? Sometimes we are rebalancing just because we've made a mistake and we are rectifying the mistake. Sometimes we're rebalancing because we're changing our strategy on the markets. Sometimes we're rebalancing as a reactiveness to something else. So I wouldn't like to associate more money being pumped into a small case during the rebalancing. I think the right approach would be to wait for dips and invest whenever there is a dip in the markets. And this year itself, you can count those, right? Like when the election counting was going on, you had a great opportunity. Pre-budget, there was anxiety and there was a great opportunity. So I think the market will keep giving these times periodically, these days where people get anxious or the markets become dodgy. And I think these are the best times to invest, because any stock look at we've had a watch list, even Mazgaon Doc, for example, look at both these times that I mentioned, election outcome as well as pre-budget, and the rally right after. So these stocks usually tend to fall massively on those days, but then they immediately pick up and give you more returns. Yeah. So we've attached the Voyager PDF here in the chat. Is it in the group chat or does it like directly come to me?
No, I have sent it to the group chat also. I think everybody should be able to see it.
Yeah, Sagar got it. Yep, got the PDF. Thank you. Sagar, one more thing. So, like you said, finding any dates to add on some funds to the small case. But what happens, let's say, if a stock has fallen and I'm averaging, and in the next rebalance, you take that out from the small case.
That it's tricky. I'm honestly, we can't time it, right? Because what happens is that's the whole problem with model portfolios. Because for everybody on this call, for example, the buying price is going to be different, and the amount of return you've made is going to be different. So it's very difficult to sort of say on a case-to-case basis what will happen. And again, like I'm going back to Mazgaon Doc as an example, because we invested in it at a price of 750 rupees. And we exited at something like whatever 4,800 or whatever, but the stock had gone to 5,500 right before that. So somebody who came into the value migration small case and invested at 5,500 and we exit at 48, they will be extremely unhappy with our decision. But somebody who's come in at a 750 is obviously going to be like all praises for how that stock has performed. So I think that's why I don't think anybody should pay attention to or pay too much emphasis to adding or subtracting or looking at losses on very near-term rebalances. Look at it from slightly longer terms and a higher duration. That's when it'll make more sense.
Yeah, thanks, sir.
Yeah, Priyanshu had a question.
Hi Sagar, I
Hi.
basically want to know about the satellite portfolio which you recently created.
We've created. So sorry. Yeah. I missed out on that question. Had come earlier as well. What we do in Voyager is that we have we adhere by an investing approach called the core and satellite approach, where the core portfolio is a portfolio which is your long-term holdings, and satellite is short-term recommendations. The short-term recommendations can be based on fundamental, technical, momentum, whatever, but they're supposed to give you quick gains, and they're supposed to be a very small portion of your overall portfolio. Now, the satellite portfolio for us over the last 6 months has been doing pretty well. We've clocked an average return of 10% on each stock and an annualized return of about 45%. So what we thought is that this was available only to Voyager customers earlier. So what we've done is we've created a separate small case as well for the satellite portfolio now. Because a lot of the investors that we had kept asking us or kept wanting only the satellite portfolio as an offering. But we weren't able to do that through Voyager. So what we've done is we've created a satellite small case now. It's priced a little high because at the end of it, we want people to look at it as a complementary holding, and it is not a standalone product. So either you take Voyager, that makes more sense, and get satellite small case with it, or if you want to individually take the satellite small case, that's there. So that's the product. It's the part of Voyager which we've made available to others as well.
So it is showing medium volatility.
I don't think you should look at that at all, because small case classifies the volatility and the benchmark according to what the portfolio composition is. Now, the satellite portfolio will at any point in time have 2 to 4 stocks in it. And because it is only 2 or 4 stocks, you'll keep seeing a constant shift in terms of how small case is classifying that particular portfolio. So right now it may be showing medium. Tomorrow it may show high, because the constituents will change, and it will be very prone to this variability, because it will have only 2 to 4 stocks at any point in time. So whenever usually a portfolio is larger and it has 20, 30 stocks, when you change 1 or 2 things, it doesn't really make a difference at a portfolio level to that extent. But with only 3 or 4 holdings, it will make a very large difference. That's why you're seeing medium right now. But I don't think you should read into it at all.
And what will happen if you don't find any opportunity in this small case?
So what we typically do is, what we've done in this one is we've assumed that at any point maximum we'll have 4 holdings on, like 4 calls will be ongoing at any point max. Right now there are only 2 on. So what we've done is 50% of the small case we've allocated to these 2 calls, and the rest of the 50% is allocated to liquid Bs, which is a liquid ETF. So what we also trying to do is that anybody investing in this small case shouldn't have to keep pumping money or withdrawing money every time there is a rebalance. Because what will happen is, today I will say 1 lakh is the minimum amount because there are 2 stocks in it. When I add 2 more stocks and the minimum amount becomes 2 lakh, it becomes unaffordable for the person who's invested earlier. So we've said that we'll keep the minimum amount same. Whatever is left over, we will invest in liquid Bs and keep changing it accordingly. So when there'll be 4 stocks, liquid Bs will be 0 and there'll be 4 stocks. When there is only 1 stock will be 25% and 75% will be liquid Bs. So that's how we've constructed the portfolio. No other questions. Probably we can wrap for this quarter. Okay, so I think we can close this. In closing, I'd just probably like to highlight that we are aware that communication needs to be ramped up from our side. So the WhatsApp community is something that we're very actively getting on. So every day you'll see some snippet on the community. Usually we try to talk about either something about what the market direction is, or we try to highlight some stock ideas that we're looking at. If we do some management meetings, etc., we'll also be putting out our notes internally on those groups. So that's the regular communication that we're trying to do on a daily basis. On a weekly basis, everybody anyway gets access to the newsletter that we have, where we talk about 1 stock every single week. We sort of deep dive into it just to show you how we think and how we look at stocks. These may be stocks from some of our portfolios or even outside. Other than that, on a monthly basis, we send out a performance update report, which talks about how the market is performing, how we are looking at the markets, how our portfolios have performed, and what the strategy going forward is. We usually try to keep it very brief because we want to explain a lot in very few words, so that we're not putting our thoughts all over the place, and we're very crisp in our communication. So that's on a monthly basis. And other than that, on a quarterly basis, we'll be doing the webinar. So I think these are the initiatives we've got, at least in terms of communication at this point in time. If anybody has any more recommendations on increasing our touch points or reducing them, we're happy to consider them and immediately start working on them and implement them as well. So any suggestions would be welcome. We're always looking to improve, so please do drop your suggestions. You have our email and this thing as well, WhatsApp. A morning market update. We can do that on the WhatsApp channel. I think every day we're at least taking an effort to talk about what the direction of the market is, or some key event in the market. We just don't want to be in a position where we're appearing like every other broker report or every other communication or every other newspaper or channel where we give information on what happened yesterday and etc. etc. So we don't want to do that, but we want to be relevant. We don't want to spam. So we're taking care of that. But yeah, we'll do that. We'll send you a morning update regularly. And good time to invest, I think we'll do that as well. Whenever the markets are falling, for example, and we think that, hey, people are panicking, but this may be a good time to invest, we'll highlight that as well. So yeah, we can do that. Great. So thanks everyone for joining. Rate cut stocks. This is rate cut is, I think, more than stocks. We would also be excited about picking up some long-term bonds because if the rate cuts are happening, you might want to lock in higher interest rates for long-term bonds. So one of the things that can make good money is fixing yourself or placing yourselves in some 10-year bonds, 10 or higher year bonds. Because what will eventually happen is that you're locking in a high coupon rate of 7% at this point in time. So that is the coupon you'll get over the next 10 years. Additionally, what happens is whenever there are rate cuts, the prices of bonds increase. So in addition to the 7% coupon, you can also gain about 4 to 5% in capital gains on the prices of these bonds till the time rate cuts happen. So if our assumption is that, say, December onwards, if you start seeing rate cuts and you see them for a period of, say, 2 years, you can probably make an additional 10% in terms of capital appreciation, in addition to the 7% coupon that you'll make. So from that perspective, long-term bonds look good at this point from a rate cut perspective. Not short-term bonds, long-term. Long-term bonds usually have more sensitivity to rate cuts. So those are the ones you want to pick up, not the short-term ones. In terms of stocks, we'll have to get back. I think it's too early to place ourselves from a rate cut perspective. Some pain has to come before a rate cut happens. So when that pain comes, I think we'll shift our portfolio again towards stocks which are high growth oriented, which are sensitive to interest rates and stuff like that. So that change will come when it has to. How do you take care of the market fall? We usually do 2-3 things. One is whenever we anticipate that markets are peaking out or the valuations are high, we increase our exposure to large caps. We increase our exposure to defensive sectors like consumer healthcare. We also increase our exposure to stocks which have more valuation comfort. So any stock price movement typically is a combination of earnings growth and valuation re-rating. We try to focus more on stocks that are not very inflated in terms of forward P. And we try to focus on stocks which have a very high earnings visibility. So wherever the order book is in place, execution is on track, etc., we ramp up on those positions. So typically these 3-4 things, if we do, we are able to contain the downside and safeguard our portfolios even during bad times. So that's the strategy. In Voyager also, we'll be changing portfolios. Yes, we've in fact, Voyager, since it's a recent product, Voyager already has an exposure which is aligned to what we are now doing in small case. So we were higher on the large cap side. We had a decent exposure to defensives. But in Voyager, over the weekend itself, we have plans of rebalancing some of the portfolios. So we will be taking the opportunity to either book profits in some of the stocks that have done really well, or cutting out on some of the stocks that we think are being a drag on the portfolio. So for all Voyager customers, I think Saturday, Sunday, we're working something out, and Monday you should have, not everybody, some portfolios will have rebalances on Monday. Perfect. All right. Thank you so much for joining in. I hope this was insightful. Look forward to see you the next time. Yep. Thank you.
Bye, guys.
Thank you, everyone.